One of the biggest crypto bills is on the edge of getting passed. The crypto market structure bill will literally transform the US crypto industry by officially legalizing and allowing the use of crypto tokens and blockchain technology widely. A bill that creates a very open and welcome regulatory environment for crypto startups while also codifying your right to custody and to keep your own crypto as well as your favorite DeFi apps like Uniswap and Aave. Crypto Market Structure Bill, officially called the Digital Asset Market Clarity Act, is changing the whole regulatory environment in the US for crypto projects, tokens, and blockchains. The bill officially passed the House earlier, but is now headed to the Senate, hopefully by the end of the month, which means you can see the bill signed into law soon. The bill actually defines terms that are unique to crypto, such as what is a blockchain? What is a digital asset? What is a mature blockchain system, such as Ethereum? And what is end user distribution, which I found interesting because what is staking and what are mining rewards? Those are not dividends, they are not net income and profit from a company, but they are unique rewards or tokens that you receive from participating in the network. And so it actually gives a legal name to those. One of the key things the Clarity Act does is that it separates what is a digital commodity versus a security. And here are some characteristics of what could be a commodity. A token that is fungible, a token that is cryptographically secured and is open source and is decentralized, and the value is derived from a blockchain network or system. For example, for Bitcoin, the network actually operates off of Bitcoin. The miners are paid in Bitcoin, and people who do transactions also pay in Bitcoin, similar to Ethereum or gas. You have to pay Ether in order to send transactions on Ethereum. Being a digital commodity versus a security or investment contract is very important for tokens like Bitcoin, Ethereum, or Solana, simply because if you are a security, then you have a lot more rules and regulations that you must abide by. You have to issue 10K annual financial reports, quarterly investment calls, many other regulations that you must do. One of the big differences is that commodities are overseen from a regulatory standpoint by the CFTC, which stands for the Commodities Futures Trade Commission, versus securities are overseen by the Securities and Exchange Commission. And what are commodities? Commodities today that we have are like oil, like silver, gold, copper. These things don't have any particular one central party that controls the price, the supply, or the operations. And that's what makes it a commodity. Once this law is passed, you're going to see most issuers of tokens or crypto projects are going to want to have their token be considered as a commodity and not a security, just because there's less regulations and a little bit more freedom for those projects. But what is a security or an investment contract? The SEC will specifically look at certain characteristics of these tokens. Is it controlled by a few people? Is the code closed source and controlled by a centralized party? If it does find multiple characteristics that they consider that it should be a security, they can come in and say, hey, due to these characteristics, you are a security and not a commodity. What you're going to see is eventually that most tokens, based on what comes out in the final version of this law, are going to take discrete moves to make sure that their token is classified as a commodity and not a security. And I think this is very important when you actually think about how blockchains work. So for example, let's take Ethereum. Vitalik isn't the CEO of Ethereum, but he's very influential to the overall development and vision for Ethereum. And so he can't control how people use Ethereum, even who has access, but he still has a huge impact on Ethereum. A post on X from Vitalik can affect Ethereum's price, whether positively or negatively. And for this reason, you're going to have regulatory oversight, for example, from the CFTC, who, although Ethereum is a commodity and Ethereum doesn't have to issue annual financial reports, the CFTC is still going to monitor things like market manipulation, scams, and fraud. And so just because a token is a commodity does not mean projects have free reign to do whatever they want. And to bring up another point about tokenized stocks, this law that's being passed doesn't really change much about tokenized stocks. Tokenized stocks, whether they're on a blockchain or whether they trade on the NASDAQ or the New York Stock Exchange, are still stocks. They're still securities, and they still will be under the purview of the SEC. It being tokenized or stock being tokenized does not change any of that. And so one benefit that is going to happen, I believe, is that in the near future, our stocks will be traded on a 24/7 basis and be tokenized. Instead of 9:30 a.m. to 4 p.m. Eastern time, Monday through Friday, you will finally have 24/7 trading of Apple, Tesla, Amazon, Walmart, and all of your stocks. I think that is definitely the future. And the technology is already there. The next part of the Clarity Act is really big, and it presents a carve-out exemption for DeFi and decentralized apps. So you think about apps like Uniswap or Aave, but it also clarifies what is considered decentralized. And those have to be open source, non-custodial, community-driven networks. Now, there are huge benefits to that because obviously they don't have to register as a security, but the carve out also protects developers of these protocols. So you think about an app like Uniswap. Although the app lives on Ethereum and that's decentralized, most people, especially retail, actually accesses the app through a front end interface, the website you go to access Uniswap. That website is done and controlled by a central party. This law allows those central parties to create things like front end interfaces or websites for those apps without having to register or have any extra legal requirements. So this carve out not only applies to DeFi, but in general to all decentralized apps. And some examples include DEXs like Uniswap or PancakeSwap, lending and borrowing protocols like Aave or Compound, yield forming or staking apps like Lado, NFT marketplaces, governance, DAOs, as well as infrastructure apps like Chainlink, and wallets such as MetaMask, Phantom, Trezor, and Ledger. All of these where maybe there's a centralized party who initially created the software or the protocol and updates it, but since the final product is decentralized, those initial creators don't have any extra regulatory requirements. I think another unique part of the Clarity Act is the ability for a token to transition from being a security to a commodity. And I think this is really goes to the heart of legislators actually understanding what crypto is and how it works, because most crypto projects today, the biggest way that they raise money is through the sale of tokens. And so when they sell those tokens as a centralized issuer, that's technically a security. But once the tokens are distributed to everyone, then it can become a commodity depending on how things are set up. And so the Clarity Act does recognize how crypto projects work. And after that initial issuance as a security, if the token is actually decentralized and fills all other requirements, the token can move from being considered a security to being a commodity. A couple of other things that's done in the Clarity Act is that it bans the Federal Reserve from creating a central bank digital currency. It also codifies the right for people to self-custody their crypto. And what that means is that you have your own individual wallet, such as a MetaMask wallet or through Trezor or Ledger, and you own the spending keys, no one but you. The difference today is that most of us own our funds at a bank account, and that bank technically has the ability to seize our funds. And so the right to self-custody actually gives power back to the users. Now we're going to get to what's the angle on how your personal portfolio can benefit from the potential upcoming passage of the Clarity Act. And I think the main thing that you need to remember is that smart contract enabled blockchains are likely to be the biggest beneficiaries of this act passing. And so you think about tokens like Ether for Ethereum, Solana, Chainlink. These are all tokens that you need to look at because they can benefit from the Clarity Act passing because it allows them to be more integrated. But remember, when you're looking at these tokens, it's not enough just to say, oh, it's decentralized. You also have to look at adoption, developer intake, and whether the ecosystem around these is growing, because that ultimately determines whether the value is going to appreciate as well. And that's what's the angle on how you can position your portfolio to take advantage of the passage of the upcoming Clarity Act. Subscribe, turn those notifications on, and I'll see you next time.